Well, hello, everybody, and welcome to the North American Bitcoin Conference. My name is Andrew Hinkes. I'm going to be the moderator today for a panel with an all-star lineup of lawyers talking about legal issues related to DeFi or decentralized finance. We have only a short period of time, and we want to provide you with as much high-quality information as possible. So I'm going to kick this right over to our panelists to briefly introduce themselves, and then we're going to jump right in.
My name is Rebecca Rettig. I'm a partner in Manette, Phelps & Phillips's Financial Services Group, and I've been working on crypto, specifically with respect to litigation, enforcement, and regulatory counseling for about the last 4 years, and really focused on DeFi, especially on the regulatory side of things in the last 2 years.
Hi, I'm Jake Chervinsky. I am general counsel at Compound Labs, which is an open source development company that built the Compound protocol, which is a DeFi protocol on the Ethereum blockchain. I've been working on crypto law for about the last 3 years or so. Before I joined Compound, I was in private practice at a firm called Cobre and Kim, doing litigation and government enforcement defense having to do with crypto.
Hey, my name is Colin Spelton. I'm managing partner at Brookwood PC. We're a boutique firm that particularly focuses on fintech and crypto companies. Previously, I worked at larger law firms, Wilson Sonsini, and a startup, Atrium. And I primarily represent fintech and crypto companies, particularly DeFi companies.
Great, and I'm Andrew Hinkes. I'm an adjunct professor at NYU and at Externado Universidad de Colombia, where I teach classes to JD and MBA students about crypto. I'm also of counsel at Carleton Fields and delighted to be part of this panel. Let's kick it right off with sort of an open-ended question. Rebecca, how do you define DeFi?
I think the easiest way to think about what DeFi is that DeFi protocols, so software, are intended to decentralize legacy finance. And so through open source software, DeFi enhances trading, through protocols like automated market makers. It also enhances borrowing through interest rate protocols, payments through a variety of mechanisms, including stablecoins, investments, as well as governance with communities as decision makers. DeFi protocols remove financial intermediaries and allow users to really make the decisions. And they either operate with the involvement of nobody or with a really large dispersed group.
I agree with that. Just to jump in, I would say that people are tempted to differentiate DeFi from the rest of the cryptocurrency industry. And I think that's actually the wrong way to look at it. I'm of the view that Bitcoin itself is a DeFi protocol. Bitcoin decentralizes the financial service of creating, transferring, and storing money. So you can send Bitcoin to someone else without relying on a trusted third party or an intermediary for that service. The rest of the DeFi space is just trying to apply the same principle of decentralization or disintermediation to more complex financial services. And that's really what the whole mission is.
Yeah, I think I'd agree with Jake, quickly. The core to me is the ability to use a permissionless protocol that allows for this type of composability that's very unique to DeFi. I think one of the hallmarks that we've seen is the ability of multiple protocols to work together, access, shared liquidity, shared networks. And I think that kind of differentiates it, somewhat from finance. But in the long run, I expect that we'll probably lose the D kind of distinction and it'll just become another branch of finance like any other type of finance.
So is it interesting and different because it's permissionless, or is it interesting and different because it somehow sort of avoids or evades some sort of regulatory obligations that attach to other similar legacy systems?
I don't know if I'd say that it's different in that it's permissionless. I think the protocols themselves could be called permissionless, but folks that wish to use them can continue to build both permissioned and permissionless services on top of it. So I think the base layer protocols being permissionless might be critical, but I don't think that being involved in DeFi necessarily means that everything is totally open and is completely permissionless. We've seen folks leverage automated market makers for permission businesses or permission services and vice versa, but it still may use a protocol that does disintermediate at the base layer.
Yeah, I think what makes it interesting is really the same stuff that makes Bitcoin interesting, which is there isn't a central point of failure for the system, and there isn't an intermediary that you have to rely on to provide some service or to protect some information or to allow you permission to access the system. So there are a lot of sort of basic and less revolutionary benefits to that. For example, blockchains are up and running 24/7, right? They don't require one company to be running a server all the time. That means that DeFi services tend to be more resilient and more robust than some centralized services are that can go down because there's a bug on one server. They also have the benefit, as all public blockchains do, of having a transparent ledger for all transactions. So whereas in traditional finance, you have a black box, which actually makes it very hard for regulators to get a sense of what's going on in the financial system, in DeFi, everything that's going on is publicly transparent and auditable at all times, which allows for a much more granular level of oversight. So I think it's wrong to view this as sort of a way of evading regulation. And in a lot of ways, this actually addresses the same concerns that regulators have about the financial system. Just instead of doing that by regulating intermediaries, you do it by creating software that provides the same types of consumer protections and assurances that otherwise are only satisfied by rules or regulations.
I agree with both Collins and Jake on that front. I think DeFi is interesting or different because it does disintermediate legacy financial services, and then by doing that, re-empowers the users of these products to have autonomy and control over their own financial transactions and to be able and their wealth management without having to rely on a third party that you hope you can trust but may not be able to. And to Jake's point, I think the transparency of the system is really intended to address what regulation otherwise requires of centralized third parties who run our legacy financial system.
So does using different intermediaries and does using software that seeks to provide similar protections to those that would otherwise be guaranteed by law, does that provide for better risk protection when engaging in certain transactions on DeFi platforms versus legacy platforms? Is it riskier, less risky, or is it just sort of a different approach altogether?
I think it's better to say that it shifts risk in the same way that you might say in a transactional agreement, you may shift risk, with different reps and warranties. I think in this case, the risk changes from being one of, let's say, potential enforcement risk because you've got the, programmatic guarantee that code should execute as written, but you replace it with protocol risk, right? Because you've got both the protocol itself that could have vulnerabilities in the software, and then you also have that compostability that we previously referenced, where if these things are continuing to build on top of other protocols, then you can potentially have contagion, just like we saw in the traditional financial system with CDOs and CDSs. So the risk is present, but I think it's shifted. Now, in particular, with respect to the risk that regulations attempt to address, I do think DeFi does potentially give us a better path in many ways for things like disclosure obligations, for things like information asymmetries. Those things can at least largely be remedied or at least mitigated through the use of this technology in ways that we previously wouldn't see. And in that sense, yeah, I think we do reduce some risk there. But the question is, do we have the right types of other third parties or other individuals that can help people assess the technical risk? And so in some ways we do replace the financial intermediaries, but unless we get either simpler code base that people can read, a more educated populace for code, including ourselves, I don't think most of us can read code, or we get comfortable with the fact that we may have to introduce different types of intermediaries, we probably will still see some third party involvement, and that may just be developers and other types of individuals that can attest to the risk or lack of risk in these protocols relative to the traditional financial system.
I do think, though, that the risk that Collins identifies, and I think those are the biggest ones, which is the sort of system failure with composability. And I also think that there are other pieces of the system that all work together. So you may have a protocol that relies on an oracle and things like that. And if the oracle fails, then it will really impact the protocol. But I do think that there are easier fixes here than there are to some of the risks that you have in the traditional financial system. So stronger, lengthier, more repeated security audits or things like that before you launch, integration audits, things like that. But I do think that finding a way to ensure that we have um, a continuing ability to educate the user base on risks is really important. But I think those are more easily remedied than the kinds of risk we see in the larger financial system as well.
So given that we've talked about risk, I think it only makes sense that we pivot a little bit and consider, is DeFi really just out on an island by itself where the government and regulators haven't approached it at all? Or are these technologies as a bucket subject to some regulation? What's the current approach look like? Jake?
Yeah, so I think first of all, stepping back and thinking more broadly about how regulations function in a common law system. We regulate actors, we don't regulate technologies. And the actors using DeFi protocols are subject to all the same regulations as actors using any other type of technology. The question is to look at the specific regulatory framework and see if there is certain conduct that subjected those actors to regulation. So I think one of the best ways of understanding this is to look at the money transmission regulations that apply to traditional financial institutions, many of which apply because those institutions have custody of their customers' funds. And when you have custody of someone else's assets, you have to comply with a whole set of regulations that make sure you're handling them well, that you're not going to lose your customers' funds, just to make sure that those funds aren't lost. One of the core principal protocols are custodial, meaning the users are always in control of their own assets. They're not pushing control or custody of those assets to somebody else. And because of that, the reason why you would apply regulations to custodians doesn't really make sense in the context of DeFi. So that might be an example where regulations don't apply because they don't have to. But there are plenty of other circumstances where the same risks apply to actors in DeFi as they do to actors in traditional finance. And in those cases, right, same business, same risks, same rules as a principle, the same regulations would apply. So we think we just have to think of it on a nuanced level like that.
I think Jake's point is highlighted by the language of most of the regulations we think about in a traditional sense. So the securities laws, the commodities laws, various state law regulations, lending laws, all talk about regulating persons, and persons is typically defined as natural persons and then also entities, whether it be corporations or even unaffiliated, unincorporated entities. And I don't think they contemplate regulating software on its own. But I think you have to think about the protocols from a practical level too. So even if the protocols themselves may be, both as Jake said, non-custodial, but also completely decentralized, where they've already been deployed and don't necessarily have someone running them, if you have the developers continuing to control the protocol in some way or maintain the protocol such that users of the protocol would expect protection from those regulation and the definition of person will apply in that context as well.
Yeah, I think buried in both Rebecca and Jake's response is something that I always go back to, and sometimes like regulatory environment. What I would expect to see is we're going to see a distinction between some of these protocols that really do enshrine these principles and actually do address the intent behind the spirit of a lot of our laws. So things like the non-custodial nature of these projects actually being non-custodial, the developers not having some type of administrative key or backdoor access that could undermine that is probably going to be the type of mitigating factor that I'd hope to see, regulatory bodies considering when making these distinctions. But otherwise, like Rebecca said, for some of these protocols, if you actually are, maintaining backdoors or there are continuing efforts that are leading people to expect certain things, then, I think it's not inappropriate to look at them similar to traditional actors, But for a lot of these developers and a lot of the protocols that actually do reach those points that Jake is alluding to, where you don't have these types of risks because they've removed themselves from the transmission process or the custodial process, and they've actually reduced those risks of information asymmetries or owning too much of an asset, then I think those folks should be viewed differently than folks that are essentially running the same types of businesses that we already regulate.
I think that one of the biggest challenges too is that a lot of these projects though are on a continuum or a spectrum where they start out because they have to being um, developed and then maintained by the software developers, and then eventually working towards the D of decentralization, and trying to get to governance by many, whereas you don't have one singular person or singular entity or actor maintaining the protocol. And so the question is, does regulation start at a certain point and then stop? And how do we really approach that? And how will regulators approach that as well?
I'd be interested if anybody wants to try to tackle that question. I know it's an open one, but many of the substantial projects in this industry are in the process of making the transition from initially starting centralized and democratizing or distributing their governance. Interested in your thoughts.
I mean, I think we've got at least some examples from across the world, with the FCA in the UK and Singapore, also having regulatory sandboxes. And it's my wish that we were a little more flexible with, I think, some sandboxes, because those seem to be the types of appropriate tools if we are going to say, look, there's a subset of platforms or developers or users that we think, given 2 or 3 years, if they can reach these goals, they should not be subject to these regulations. And rather than starting them off in a quite heavy regulatory environment that's probably not tailored for an early stage startup, and then later telling them to stop disclosing or stop providing information to the market, I think it would be better for us to start in a sandbox where we're saying, look, we're giving you a certain amount of time. If you can reach these goals in that time, then we'll give you, a certain particular status or exemption from certain applicable laws. But if you don't, we're going to expect you to comply just like we would any other type of intermediary, since it shouldn't take you, 3 years or something like this if you're, giving these people promises. Now, those are obviously all numbers being pulled, but I think we do have some indication that there's a willingness to consider things like that with Lab CFTC at the CFTC, the SEC's FinHub group. They're active in the community, but I think some of our international partners probably have better examples of actually leveraging sandboxes to their advantage. Singapore probably being one of the best examples of that, and I think it's paid dividends in the number of significant and legitimate companies that have migrated to that regulatory environment and have been working with the MAS over there and their regulatory body, I should say.
So you bring up a good point there, Collins, and that is, notwithstanding that these DeFi systems are supposed to be designed so that they do not trip up obligations created by the regulation that applies to many of these businesses, it's not as though these regulators are simply ignoring or pretending that they do not see what's happening with DeFi. From conversations, it's quite obvious that they are studying these platforms and trying to learn about them. On December 14th, Professor Aaron Wright and Gary DeWall went and made a presentation to the CFTC urging a pretty hands-off, let's wait for things to develop type of approach to the CFTC. Curious for all three of your comments, how do we see the big three regulators, the CFTC, the SEC, and FinCEN, approaching DeFi? Where do we think that there are opportunities? If you could speak directly to these regulators and give them your air quotes expert opinions or suggestions as to the approach, what would you think would be good nuggets to share?
Yeah, I think those are definitely the right three primary regulators who are looking at the space now, because their regulatory frameworks, the anti-money laundering laws, the securities laws, and the commodities laws, are most clearly implicated by this technology. I think that all three of them are taking considered approaches based on how their regulatory frameworks apply in particular, and they are very different in all three cases. So I think just running through them quickly, I think FinCEN has done a fantastic job of explaining how it thinks the anti-money laundering laws apply to decentralized protocols. So we got some really sharp guidance from them in May of 2019. explaining when they think there is a regulated financial institution involved in one of these protocols, and also when they think that there isn't. And I think one reason why it might be even easier for FinCEN to provide guidance like that than for some of the other agencies is because they understand there are other ways for them to accomplish the underlying goals of the anti-money laundering laws than by simply applying the traditional framework to this new technology. What they're concerned about is tracing the flow of illicit funds through crypto protocols to identify money laundering or terrorist financing. And what they realize is there are third-party contractors like Chainalysis or TRM Labs that can do that kind of analysis without having to apply the same regulatory framework to a software developer that you would apply to a bank, which frankly doesn't make a whole lot of sense. So I think FinCEN has gotten pretty far in understanding how it can achieve its mandate in a way that is consistent with innovation. SEC, the SEC is coming off of a major enforcement effort having to do with the ICO bubble of 2017, which, I think we could sort of debate the particulars of the ICO bubble, but in general, I think it was an attempt to evade the securities laws, right? An attempt to issue unregistered securities in a way that clearly the securities laws were designed to prevent in an unregistered fashion without disclosures. So I think the SEC is being a lot more cautious in giving advice about this space until they really understand what's going on in DeFi and how it is categorically different from ICOs. And I think it's just going to take them time to see DeFi develop before they sort of jump in with their perspective. Similarly, so from the CFTC's perspective, there are DeFi protocols that are performing functions that traditionally a registered derivatives exchange would be performing, except without that intermediary in the process. And there are potentially some systemic risks that could create that the CFTC is charged with monitoring. So I think they're really trying to think through how much of this innovation they can support and where they do need to jump in. So I think the SEC and CFTC are just a little bit further behind FinCEN in grappling with how to address the space.
I think one of the ways that that CFTC and the SEC should approach DeFi is very much like, as Jake said, what FinCEN did. So think about what the underlying purpose is of each of their laws, and then put out guidance so that these projects can really make sure that they're working towards those goals. So for something like the SEC, the general U.S. securities laws, there's transparency, right? So no information asymmetries and general protection of consumers. Here, I would think of users of the protocols. And there are sort of, as I alluded to before, and I think as we've all talked about throughout the panel, ways to do that. So ensuring that the developers have disclosed all information that is relevant at any time, or that all relevant information is somehow publicly available to all users of the protocol. That relates to not just how the protocol operates, but the security of the protocol itself, whether there's any intellectual property that relates to the protocol, a variety of different things that may be important to users on a number of different levels. And to put out guidance like that, especially on the security side, because I think, as we talked about before, system failure is one of the greater risks that we face, and as a way to think about consumer protection for those who may be any of the protocols that have crypto assets that are securities running through them. And I think that's a really important distinction, or that otherwise fall under the definition of the securities laws, will really help developers and also continue to encourage innovation in the United States, because as Colin sort of talked about before, there are other jurisdictions that really have embraced crypto in a different way and given either guidance or the ability for crypto companies to try to develop over time. And we've seen companies going offshore on a somewhat frequent basis. And so if we want to keep innovative, interesting financial technology companies in the crypto space here, then the same type SEC and the CFTC.
Yeah, I think, I'd echo Rebecca and Jake. I will say I may be one of the stranger lawyers when it comes to the SEC in this space, and that I think and I'll get to that in a minute as to why it may be controversial, my view there. First, but the FinCEN CFTC, FinCEN, I agree. I think they've done probably one of the better jobs of like international regulators generally. And part of that, I think, is because, like Jake said, they've got a clearer mandate, I think, that is not as sprawling as the other two agencies, and they can produce more targeted guidance. But in addition, I think the actual substance of their guidance is probably the most directionally accurate of a lot of international regulators in terms of identifying when they do need to step in, when there is actual transmission of funds, or when there is accepting and transmitting a virtual currency or some other type of administration activity versus others. And in particular, for instance, I think their views on decentralized exchanges are probably the appropriate ones in the way that they view these things. The CFTC, I also think, is, in general, they're hands off, and I don't know if I'd say it's necessarily hands off, even though you probably used that quote, but I think their wait and see approach is probably more appropriate for them, because in general, the commodities laws have a slightly different aim than our securities laws, which they often are compared to. And in particular, things like information asymmetries and disclosures are different in the commodities law world. Like the classical theory of insider trading, where there's just information asymmetry, doesn't necessarily hold in the same way that it does legalese here, but the history of commodities versus securities markets dictate that. But when it comes to the SEC, I actually think additional guidance would definitely be helpful. But I also think that sometimes, and I don't think this is Rebecca and Jake, but I've seen a lot of quick bug lament the fact that the SEC, because there are a number of pieces of guidance from them that are, to be frank, kind of clear. And a lot of people are just looking for tea leaves that aren't there. And that's when it gets back to kind of this whole true versus non-true DeFi thing. But more fundamentally, I think the critical issue with the SEC that we don't often talk about is the fact that, in general, I think a lot of our security law disclosure regime, not just for virtual currency, but for equity securities, is probably outmoded in today's world. When you look at, like S1s, but also 10Ks and 10Qs, the kind of filings that people do. And in general, the public is often relying on third parties or analysts or something to interpret that data, because over time we've increased not just disclosure obligation, but the formality in which it's done and all of these things. So I won't get into, like railing against the securities laws. I think they're generally pretty good. But I think the broader point is the SEC is at a point where, realistically speaking, a lot of these projects probably do touch on the securities law requirements that are currently drafted. But the real question isn't, should they be exempt? It's really, are our laws appropriately tailored for the type of retail users that are currently participating in our securities markets? Because to be frank, I look at some of these crypto projects, which may or may not be securities, but their governance calls and their community outreach is probably more informational for the participants in those networks than a lot of the calls that we see in pubcos, where a lot of your retail participants have no idea how to interpret financials or things like that. Now, it doesn't mean that suddenly we should let all of these public companies just stop disclosing financials and the like, but I think the question is starting to become, if we impose all of these requirements on these entities, are we actually going to get helpful disclosure and information to users, or are we just going to overload them with a lot of information that doesn't actually help them make informed decisions and drives innovation away? And so ultimately, I guess what I'd say is, I think the SEC has a tough job, because some of the application of the laws may actually be inevitable in the way that they're currently drafted, even if it doesn't make sense for virtual currencies. But I do sometimes struggle, because sometimes I feel like our industry wants an exemption, and it's appropriate for the substance, but it's also kind of like saying, hey, our laws are somewhat broken or janky right now. Instead of fixing them, why don't you just exempt our industry, and the rest of the world can deal with that? And that, it's weird to me, because I don't like the bad outcome of laws, but I also don't like special treatment for a particular industry, even if it would benefit us. So that's my controversial statement for the piece here.
To me, that's not so controversial. I totally agree. I think the securities laws are very important as a policy matter, right? The point of the securities laws, among other things, is to protect investors from companies or projects that want to take their money on the promise of delivering them profits based on their efforts. And the goal is to make sure that if investors are going to part with their money, that they have the information that they need to judge whether that investment is a good one or a bad one, in cases where it is only the company raising the money that has that information. I don't think there's any reason why we should change that core concept. That makes a lot of sense. And like Collins was referencing, we hear a lot of our fellow lawyers in the industry complaining about the fact that we're applying such old laws from the 1930s to this new innovative type of technology. And I think my reaction to that is that's exactly what we're supposed to do in a common law system, right? We take core principles that are written down in law at one time and we apply them to new types of activity that sort of pose the same types of risks and issues as were contemplated at the time the rule was drafted. I do think there are areas where we could get some more clarity around the securities laws, but in general, I think, I agree with Collins completely that the point of the securities laws applies in the same way. I think shifting that a little bit into the commodities laws, as Colin said, it's important to understand the differences in the goals that these regulatory regimes are trying to accomplish. In the commodities law context, it's less about protecting specific investors who are making investments in a company or a project on the promise of profits based on those efforts. It's more about protecting the financial system from the risk of derivatives, which, going back to the global financial crisis, were termed weapons of mass financial destruction. And one of the reasons that we had Dodd-Frank was to give the CFTC more insight into whether there is systemic risk in the derivatives markets. At this point, the derivatives in crypto are so small, in the scope of the total number of derivatives in the world, that they just don't pose any systemic risks. So it makes a lot more sense, I think, for the CFTC to take a slower approach to understanding what does this technology mean, how can they achieve their mandate, based on activity using these new protocols, whereas the SEC may have more reason to jump in where there is some issue of an investor who really does need protection at this point right now.
So here, I'll tee this up for everyone. We've talked about how the SEC requires disclosures and that they're generally helpful for investors in some circumstances, but that the products and systems that have come to the fore from DeFi don't necessarily map one-to-one with those disclosures. Jake did a really wonderful job of talking about the different policy issues with respect to disclosure in the commodities context versus the securities context. I'll kick this to everybody for some comments as we close out here. If you could change the disclosure requirements that exist in both the securities and the commodities world to apply to DeFi projects, what kind of disclosure do you think would be important or helpful for those who want to actually engage in these DeFi platforms? What would you require issuers or control parties to disclose if you could remake these laws?
So I can definitely start both as kind of a counsel here, but also as somebody who's an avid kind of observer of the space.
Is that code for degen?
Yeah, no, I just observed the general market. But I think that the first thing, and probably the most critical in my mind, would be disclosure of continued developer control of an ostensibly decentralized protocol. It's by far the most critical thing. We've seen countless times, not just developers advertently taking people's funds and absconding with them with rug pulls or any type of thievery that you might expect, but also the fact that when those admin keys or those upgrade keys exist and developers try to unilaterally do things, they often inadvertently introduce bugs and end up creating a user loss. I mean, this summer alone, I'm aware of at least 5 projects where, the developer could be lying, but they've stuck around, they're publicly known, where they've accidentally implemented a change that locked, millions of dollars of funds in. So that would be the first. The second would be actually closely related to that, disclosures about how amendments or changes could be made to the network and the timing of those amendments. There's a pretty common concept known as a time lock for a lot of these smart contracts, which essentially say, even if these contracts are upgradable over time, there's some type of delay, which allows users to withdraw their funds or take some other type of action in the interim that needs to be disclosed up front, because it's kind of critical for people to understand, how can this thing that I may be purchasing or investing in or using change without my consent? And what are my remedies in the interim if that thing is to change? And then I think the last would probably be disclosures in particular about the types of dependencies that the network relies on and the vulnerabilities there. And in particular, the things that we typically see are Oracle risk and the other types of platforms they connect to, because we've often seen, some type of catastrophic failure, not with the protocol itself, but with some other appendage that it uses, having some type of contagion. And that's the type of thing that people should understand. And that's, very closely related to like your very kind of simple systemic risk. I think yesterday we just saw a major protocol launch, and a simple disclosure of telling folks, hey, if you provide a certain asset too prematurely, it is likely that arbitrageurs will take most of your funds. That type of thing should have been disclosed. And we saw within 6 minutes, people lose, a couple of $100,000, not because the system was broken, but just because a lack of information and a lack of understanding by fairly experienced users required them to lose that money to learn that lesson. So those would be my 3 or 4 things that I think would be the most critical thing that would be needed to be disclosed to potential users in order to help them make more informed decisions.
I agree with Collins, because if you think about it, especially if we're going back to the SEC information asymmetry issue, once you're in a world of decentralized governance where the users are really governing, they have all the information. I mean, unless, to Colin's point, the developers are still controlling, hold the admin keys, have some ability to do something to the protocol that everyone doesn't know about for some reason. I think the other thing that's important and sort of plays into what Collins is talking about with the systemic risk issue is the security audits. And not just that there's been an audit of the protocol, but also a full disclosure of what happened with the audit and what was done to rectify it after the fact. Because there are lots of protocols out there that say, oh, we had a security audit. And then you find out after some massive failure and tons of loss that they knew about lots of bugs and did nothing to rectify it. So I think since consumer protection is just a generally important issue, and there's a whole regulatory regime about consumer protection as well, I think that we need to make sure that, especially if you're just going to launch a protocol and walk away from it, that the level of security audits that were done before launch is really important. But otherwise, I'm in complete agreement with Collins.
So really quickly, Rebecca, are there any bodies or organizations that have articulated audit standards here?
I'm not aware. I've heard of various bodies talking about it in terms of in terms of thinking of themselves as a self-regulatory body or putting out standards for the industry. And maybe Jake and Collins knows, but I haven't seen anything come out that really has, from a regulator or other type of regulatory body that sets standard for security audits.
Yeah, I'm not aware of any standards. There are some industry organizations that are looking to do some self-regulation in that sense, but I don't think anything super helpful has come out yet. Otherwise, everything that Rebecca and Colin said sounds right to me. I think the only point I would add is, aside from just having disclosures of information, I think there's room for us to think creatively about other ways to protect investors using the technology itself. So one example of that is this function in some decentralized protocols called the rage quit function, which basically allows investors to exit with their money from the system at any point if they feel like what's going on doesn't make them comfortable. And this is a real change from a technical perspective, an engineering perspective, from the traditional securities world. In a traditional securities arrangement, you have pooling of investor funds, but the funds are controlled by the company that has issued the security. And often the investors don't even know on a day-to-day, week-to-week, month-to-month basis how those pooled funds are being used. One of the great things about DeFi is you can move all of that activity, all of those pooled funds, onto the public blockchain where it's all transparent, and you can create systems where the investors have a claim on those funds so they can exit at any point if they want to. Now, that may create some business issues, right? Not many companies want to be unsure of whether their investors are going to abandon them by sort of self-redeeming their investment at any given time. But that is a way that you can protect investors in sort of a new and innovative way. And I think we need to start thinking about that kind of protection as well.
Wonderful. Well, I'll close this out just by welcoming our panelists to volunteer any other final comments they might have in the realm of DeFi and regulation. So open it up for anybody else.
Yeah, I think I'd end with maybe two things. One thing I think that probably still needs a greater consideration, and I'm hopeful that this year we'll see more of this, are the intersection of kind of blockchain technology and privacy regulations. In particular, as these things start to get real adoption, we've seen that there's going to obviously be a regulatory reckoning. We expect that there's going to be additional kind of pieces of regulations kind of built on our legal edifice here. And I think the challenge in front of a lot of us needs to be to better understand how these data flows are being captured and where we need to start erecting some protections for individuals. Because unlike traditional, finance, the information that's captured here is, arguably, permanent, and it's highly detailed, and it's kind of a detailed map of not just the user's financial transactions, but also social interactions and other things. And so disclosure of, a simple account in a traditional financial world is nothing like disclosure of, a wallet that's been used for years and may, speak to an entire individual's history. And then the second point, I think, is in general, I think one thing that is often lost in the discussion of the US regulatory regime is just the robustness, and not to like wax poetic, but also the sheer amazingness of the Constitution and what it actually does protect. And in particular, a lot of folks, they'll often kind of, rail, particularly those outside of the states, on the US for being kind of too draconian or not being willing to bend. But at the same time, our First Amendment and our Fourth Amendment provides some really radical protections for people to be able to innovate and develop a lot of these, technologies with, very, very strong protections, probably unlike anywhere else in the world. And it also protects people from having their assets seized. Now, right now, we're in flux, we're figuring out laws here, but I suspect in the long run, the US is likely to be one of 2 or 3 top jurisdictions, if not number 1 in the States. And not just because I'm an American, but in particular because I think our underlying Constitution is going to empower individuals that really want to explore the bounds of this technology and what it enables, because of our First and Fourth Amendment protections. So that's my speech on this inauguration day.
I mean, it's very hard to follow that up because it was actually pretty poetic in a legal regulatory tech sense. So I feel very inspired after that, Collins. But in the same vein, I think that there is extraordinary promise in DeFi. I think we are just at the beginning. And so what I'd like to say generally, and I have found this to be the case, is that companies developing DeFi protocols should really think about regulation early, and not in a way of, oh, do we need to be regulated or not, but how do the regulations interplay with what we're doing, and thus how should we structure, one, what we are building and developing, and two, the company around it. So making a governance plan early and thinking about the timing of that, thinking of ways to mitigate risks, doing all the disclosure that we've talked about and ways that it can happen. And so I think accepting that regulation has some form of interplay with the new financial world that we're putting together, and then really building your business with that in mind is really important. I think will allow the DeFi system to grow even greater. I agree with what Colin said at the very beginning, that we may not have the D in DeFi forever and ever, and it will just become another arm of our financial system. But I think if there's an understanding that regulation should be considered from an early point in time and can be mitigated in a variety of different ways, that will be important and allow DeFi to continue to grow.
Jake, you're the cleanup hitter. Take us home.
Yeah, well, I'll echo what my colleagues said, and what a pleasure to speak with you all about this. I guess, my last thought is, I think it is it is apparent to anyone who understands what DeFi is that this is the future of finance. There's just no question about that. The benefits of these protocols, the advancement is an order of magnitude above the traditional financial system. There is simply no question that this will become, in one form or another, the future of how the global financial system operates. We also know that open source software always wins. The majority of the world lives on open source software, and that's because whenever something is open, whenever there is more competition, you attract a vibrant ecosystem of developers who will build on it, and you end up with better services for consumers. So I think we just need to understand that this will get built. And what we need to do is reckon with how we can make sure we're managing risks just like we have in the traditional financial system, so that we can deliver those benefits to consumers and the rest of the finance industry as quickly as we can.
Wonderful comments. Collins, Jake, Rebecca, thank you so much for joining us today. Thank you for joining everyone who's attending TNABC. Your thoughts and your comments and your perspectives are invaluable. I learned something from you every time we get a chance to chat. For everybody who's at TNABC, thanks so much for joining us. And go take care of your local DeFi developer. But most importantly, if you're unsure of the regulatory status of a project that you're engaged in, please call your regulatory lawyer. Take care, everybody. Bye-bye.
Thanks.